In this video, I want to talk about how to build and manage your own permanent portfolio. So you'll remember in my last video, I introduced the permanent portfolio. This video, I want to share a little bit more about the mechanics of how you might go about building your own permanent portfolio and manage it on an ongoing basis. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder, and I have made this channel to share with anyone who's interested the various concepts, ideas, and thought processes I go through to manage my own money. I cover topics like this, wide-ranging, also including asset classes and very specific niche strategies as well. And like this one, I try to provide some value to those who are interested in finding out a little bit about alternative ways of investing. So I hope you enjoy. So jumping right into it, as I mentioned, I did cover the introduction to the permanent portfolio in my last video. I will link to it in the description of this video. So this screen you see before you is just a reminder of what it is. Basically a very simple portfolio structure where an allocation is given to each of equities, cash, bonds, and gold, with the idea that those asset classes are uncorrelated enough such that they can basically cover any sort of economic macro season that might be presenting itself in the markets. So just to jump into kind of how that might look for somebody who is managing their own portfolio. So let's start by talking about what investment vehicles might be used to cover each of those asset classes. So what I've done here is basically broken it into two types, basically US dollar and Canadian dollar, depending on which side of the border you are on and how you like to invest, what type of currency you like to hold. Bottom line is that the cheaper the better. So whatever investment vehicle you choose, I generally like to favor ETFs for this type of investing. So we'll just rattle off these so you can see why I like to use these types of funds. So for the US dollar side, I may have mentioned before the ETF SPY, which is the S&P 500 index, has a management expense ratio of 0.09%, which is quite cheap. TLT, which is the long-term bond component of that, iShares 20+ Year Treasury Bond ETF, management expense ratio of 0.15%. This strategy does use the longest term duration bonds possible, only because you get the best reaction from that asset class in the event that interest rates fall. I've covered this in other videos, but the longer the duration of a bond, the greater the reaction to changes in interest rates. So it makes the longer the bond, the more sensitive it is, and therefore when interest rates fall, the bonds in this asset class will jump in value the greatest. So that's what you're trying to do here, is maximize that reaction using this asset class. On the gold side, in US dollars, GLD is probably the biggest one out there, and it's the SPDR gold shares with a management expense ratio of 0.4%, a bit higher than the other ones. It does deal with physical gold, and there are challenges with holding physical gold, so likely why the MER is a little bit higher. And then SHI, now this in the pie chart you saw in the previous screen is generally speaking the money market or the cash piece. I'm using iShares Trust 1 to 3 year Treasury Bond ETF only because, you know, and you could go into the true money market funds, but the interest rate is so abysmally low, and there's still a management expense ratio on those funds, so your return is virtually nothing. This gives you exposure to treasury bonds, which, you know, in my mind are still extremely safe. It gives you a little bit of a yield. They are short-term bonds, 1 to 3 years, so they're not sensitive very much to changes in interest rates. They cycle, between 1 and 3 years. So every bond is basically cycling, within that time frame, and adjusting itself to the new interest rate. So it doesn't really have much fluctuation when interest rates change. So it's the best proxy with a little bit of yield to a true money market fund. But by all means, you can investigate other options. And this one, of course, has a MER of 0.15%, which isn't bad. On the Canadian side, if you have Canadian dollars you want to invest, VSP, so I've chosen some Vanguard funds. Vanguard's got a pretty good track record of keeping things pretty cheap. So Vanguard S&P 500 ETF with a Canadian dollar hedge on it. So it basically allows folks in Canada to buy the S&P 500 index with Canadian dollars using this ETF, MER of 0.08, so actually even a little bit cheaper than SPY. VLB, Vanguard Canadian Long-Term Bond Index ETF. Basically not much, none of the bonds in here are greater than or less than 10 years, or at least no significant portion of the portfolio. The majority of them are over 15 years. MER of 0.17, so it's a pretty good fund, I found, and still gets a good reaction when interest rates change. On the gold side, I like the Royal Canadian Mint Exchange Traded Receipts. This is a fairly new product. You can actually get this in the US dollar as well. It's MNT.U. MER is a little bit less than the GLD in the US, and every single paper traded through this fund is backed by a physical gold held by the Royal Canadian Mint. So, from my perspective, I like the Royal Canadian Mint. I know it's pretty safe, and I like the fact that every single piece of paper I hold is backed by physical gold at the mint. GLD claims to do the same, but I don't think they have necessarily the same tracking as they do with every single piece of paper to physical gold. But again, I could be wrong. VSG, again, same idea as the previous slide with the US side. This is the short-term government bond index ETF, MER 0.18. Again, provides a little bit of yield. This would be a proxy for the money market type product. It does give you a little bit of something where, again, the true money market products right now I think are just not giving enough. But again, don't let me stop you from investigating other options. This is just my personal choice for this asset class. So those are the range of vehicles. Again, look for the cheap ones. That's really going to give you the best bang for your buck. In this type of investing, that it's all basically trading the same bucket of products. So you might as well just pay the lowest possible fees you can to get that bucket. In terms of, so once you've got your actual products selected that represent each asset class, the next thing is coming up with your rebalancing rules. So what that means is, the first part of that means band selection. So we initially allocate 25% to each asset class. What you'll want to do is rebalance periodically, and the best way of doing that, in my experience, is to set parameters around those allocations. So for instance, if you set a 10% band around 25%, that means that you will rebalance your entire portfolio if any asset class goes outside of, between 22.5%, it goes below 22.5% or above 27.5%, that's a trigger to rebalance the portfolio. If you wanted to be a little bit more aggressive and let your winners run a little bit longer, you could choose a 20% band. So that putting that around 25% would mean if any of your asset classes fell below 20% or grew greater than 30%, that would be a trigger for rebalancing. So it's a choice. There's no right or wrong answer here. And then, secondly, once you've chosen your bands, the rebalancing frequency is the next choice. So do you want to review your portfolio monthly? Do you want to review it quarterly? Do you want to review it yearly? Again, very much a personal choice, what your schedule allows for, how interested you are in checking it, all of those things. I wouldn't say you need to check it any more often than monthly, and I wouldn't say you want to let it run for years before checking it either. So, one of those three options usually is a fairly good thing, and then you mark it in your calendar. You go ahead and you check around, check your portfolio. If anything's outside those bands, then you would go ahead and rebalance. So that's kind of the managing portion of your portfolio. So number one, of course, is follow your own rules. So reviewing your portfolio at your chosen interval. Make sure you're doing that. Check if any asset class is outside your band range, obviously, and then if so, then you would rebalance. Rebalancing should not cost more than $40, and I use that number because most discount brokerages charge no more than $10 per trade. So if you are rebalancing, that may mean buying or selling in each of those 4 asset classes. That's 1 trade per asset class. That's $10 per trade, so $40. If it costs any more than that, then you should probably switch to a different discount brokerage. And then, just as an example, what does that mean on an annual basis? Using those 10% bands that I showed in the previous slide, it shows that on average, rebalancing, if you're looking at it on a monthly basis, should happen about once per year, no more. Sometimes in a year you might get a couple of rebalancings, but that's pretty rare. So that is basically the long and short of managing this type of portfolio. Again, pretty simple, pretty easy to do. And just to give you a little bit of an idea of what that looks like, this is just a spreadsheet going back to 2009. If you invested $10,000 in each of those asset classes from the 1st of October 2009, the highlighted numbers are just the points at which those asset classes fall outside of those 10% bands, and which would require you to rebalance. And I'm just showing a rebalancing in the month following each instance. So on average, over 10 years, going all the way up to 2019 October, there was 11 instances of rebalancing in that period. So overall, I think you'll agree it is a pretty simple portfolio structure and process to follow if you are interested in following this process. So hopefully that was helpful for you. By all means, if you have different strategies you like to use that help you mitigate your own risk in your portfolio, by all means, leave those in the comments below. If you do like the video, please do hit the like button and give me a thumbs up. And if you are new to my channel but have not yet subscribed, then by all means do hit the subscribe button if you want to see more of the similar content you saw in this video. And of course, if there are any other topics you'd like me to cover in the future related to this or not in the investing space, by all means leave those in the comments as well. Until next time, thank you very much for watching.